Hi, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is David L. Steinberg, who is the president of DLS Capital Management. David, thanks very much for coming on the show.
Thank you, Mike.
You were just recently in Chicago at
That's
the
right.
Index Universe conference. I believe you were one of the speakers there.
Correct.
What did you talk about?
Well, I think what we had talked about primarily was the fact that we thought commodities over the long run are going to go quite a bit higher due to two major variables. One was continued printing of currency, both in Europe, United States, and Japan, to kind of fill the budget gaps, deficits, and how that's probably not going to change anytime soon. And secondarily, really looking at emerging markets and the fact that we can see the rise of the middle class. And the demand variables that you're going to see a lot more demand for stuff to fill those needs. But now we see sort of a pause in some of these commodities.
Maybe could that be related to a slowdown, economic slowdown in some of these emerging markets that you mentioned?
Yeah, I think that there has been a slowdown. It's kind of been tough actually for the last 18 months. I'd say it started when the European banking system really got spooked. And that's because you have so much lending that goes directly from the European banking system into the emerging markets. So credit's tightened up a bit, as well as Europe inputs a lot of goods from various parts of the emerging markets. So it's a chain, and it's related. And you'd like to believe there's going to be a handoff done where emerging markets can stand on their own and there'll be natural commodity and excess demand. But there still is a connection, and they're still intertwined. So when we slow down in the United States, they slow down in Europe, you're going to get slowdowns in emerging markets, and therefore a bit of lower demand overall for commodities. That being said, you still see emerging markets growing at 4.5% this year versus 1.5 tops for the developed countries.
Right. Now, are there any particular markets that stand out to you? I mean, would you look at something? You mentioned the stimulus, the money printing. So would that be gold? Or what about oil? Because we have geopolitical factors which might play into that.
Right.
What about something like natural gas, which is very depressed, or agricultural? We had the big drought over the summer. Is there any particular area that stands out as looking more favorable as opposed to some of the others?
Our opinion is they're going to continue to print money around the world. You've got to print money or you're going to have a dramatic slowdown.
But isn't austerity, it's the unprinting of money. I mean, when governments impose austerity, they're literally taking away money that they've printed before. So how do you make the argument about printing money when Europe is in full-blown austerity? We're about to go into our own austerity. That's sort of like the unprinting of money, if you will.
Well, actually, they're trying in Europe to have austerity applied to some of the smaller countries. The reality is the ECB is picking up the slack from money being withdrawn out of the banking system. So you've got two things kind of going on at once, but the net is there's a larger balance of ECB currency or euro currencies being created. We're still printing money. I mean, and any way you look at it, quantitative easing is a form of backdoor monetization of debt. Japan also is doing the same and stimulating. So we're in a tough math problem here. I mean, things don't add up. There's no way you can slow and provide austerity without slowing down the economies. There's not going to be a magic bullet. If these countries and these developed nations decide they're going to try to fix things through austerity, you're going to see these commodities come in quite a bit.
They're going to come in quite a bit.
Mm-hmm.
So here, for example, we're facing the so-called fiscal cliff. If that happens, if we go over the cliff, and it doesn't seem like there's any way that we can avoid it at this point, but if we go over the cliff, you're saying you're going to see commodities pull back appreciably?
I think they can pull back. I think it's going to 1% GDP, factor to the United States. So you're going to see some slowing.
That's it, just 1%.
I think probably overall, by the time you kind of drift it and trickle it all down and through. Now I know guys have probably got bigger numbers than that.
Because there have been some 5% numbers out there, like negative 5 GDP. That's huge.
Well, what would negative 5 GDP be?
Well, that would look like what it was in the fourth quarter of 2008 after Lehman failed, basically. That's a scary number.
Yeah, and you know what? They could be right. You can't argue. You don't know what. Remember, sentiment is a big variable. And you start to see things slow down, and you can tighten, everything can overdo it. And that's a possibility. I don't see it that way, and maybe I'm wrong. I'd also tell you there's a lot of that built into a number of these commodities. And you're mentioning nat gas. Nat gas is, they thought the world was going to come to the end because of excess supply. It's actually, I think, up for the year now, or done pretty good, at least in the last quarter.
Yeah, it has been. It has been. It's still historically quite low, but there are still huge inventories of natural gas, and we're finding a lot more of it because of new techniques like fracking and that sort of stuff. But let's talk a little bit now about you've been in this for a fairly long time.
Right.
You're a long-term investor. Do you see this as a secular move in commodities, or is this something that's cyclical, ultimately will play out like other booms where commodities come back down to price levels that equate to cost of production?
Well, I think it's a larger scale due to the emerging markets. And remember, things aren't not linear. Everybody, investors, and ourselves, we'd love to see this as linear growth. The reality is economies are not linear. So I think unless the story gets broken, in emerging market story breaks, where the governments don't want them to grow, or something gets derailed, South America or Asia, you're going to have growth. Okay, you may, albeit, have slower growth if there's austerity going to be in the developed nations. So I think time will tell. In the meantime, oil's $90 or just below $90. Okay, even with the major developed countries, probably at 1 or 2% GDP growth. So it's staying elevated, and they are demanding oil. There's no question. You can't just store it.
Oh yeah, you could look at Saudi output, which is at a 40-year high. Even in an economic environment like this, it's telling you right there that there's a strong demand for oil. Now, how do you play this? I mean, do you play this with individual stocks? Do you play it with ETFs? Do you play it with futures? How do you go about doing this?
Good question. I don't use futures because we run basically a global value equity fund. So we're using primarily a modest number of ETFs to give us some broad diversification, particular industry groups, and primarily the balance of it actually is in individual companies. For example, for copper exposure, we're using Freeport McMoran. And that's one of the largest copper companies in the world. Copper is still up for the year and in big demand. Granted that everyone thought China was going to fall off the cliff, it's still in big demand. We can use the large oil companies, whether it's a Marathon or it's a ConocoPhillips, or even British Petroleum. In areas such as agricultural commodities, we've used ETFs that kind of provide us exposure, but you can also secondarily use the fertilizer and the potashes and the mosaics to catch demand there. And you've had a drought this summer. You had a really tough period for agriculture in the United States and around the world. So I think you're probably going to see a lot of pickup in the need for this, the chemicals. So I would tell you that the producers and the things that we're involved with are more or less like the printing presses for the various commodities, and that's kind of the way we want to beat that bush.
Now, with the people you talk to, maybe your clients, prospective clients, institutions, what's the sort of attitude? I mean, are they very open to commodity investing? Are they somewhat open? Are they still a little bit leery? Like, how would you gauge that right now?
I would tell you that the intellectual argument, they definitely, they get it.
They buy it.
And they buy it.
Yeah.
I would tell you that they don't like the volatility of the way that those particular groups of securities, especially large individuals. People right now are in safety mode.
Right.
Okay? And when you're in a safety trade, you don't want things that are volatile. So I would tell you that there's been a vast degree of underinvestment in these companies, and you can do that by looking at the valuations. You've got oil companies trading at 3 and 4 enterprise value to cash flow multiples for the whole businesses. And you've got that same with most of the mining companies, which granted they're cyclical and they do run lower multiples, but these are far below the standardized normal mean multiples. And that's against basically no yield in the bond markets. So I would tell you that people get it, but they're not participating, or their desire to participate is at a de minimis level at the moment. Now, what changes that? It may just be optimism that things are going to change from a political or geoeconomic perspective. I can't give you the timing on that, and this debt situation globally is not going to go away anytime soon. However, what may very well happen is investors get used to the fact that that's hanging out there. You got to remember, there's many places in the world where they're being under serious war conditions, as example in the Middle East. The Israeli stock market can do fine. I think it's going to be part of investors getting used to the new normal, if you want to call it that, which is going to be low growth, emerging markets growing a little bit faster, and the fact that things aren't going to be linear and perfect. The way they kind of had been, the Fed just kept printing money, everything kind of kept moving along, and there was always that but. Well,
like with any deep value investor, you have to have a lot of patience, but patience is usually rewarded, right?
Yeah, I mean it is. It's time is like the fairy dust of the business, and you wish it would always work exactly when you want it to work. The reality is it works in its own way.
All right, David Steinberg, thank you very much.
Pleasure. Thank you.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.